Well, Janet Yellen's clearly biased, right, because she started on this path. But the key issue in the market is what the market is pricing the Fed to do and what the Fed is telling you that they're going to do. And quite frankly, what the Fed is telling you, continuing rate rises, double what the market thinks next year, I think is too much. And until that comes off, which I don't think it's going to, the markets are going to continue to be in this kind of volatile zone.
The messaging for the Fed, from the Fed, though, has been pretty clear about the anticipation of inflationary pressures from this very strong labor market that we've seen in the US. And Steve cited the confidence data that I think we saw yesterday, which looks remarkably robust. Is there not a risk that the Fed looks as though it's falling behind the curve if it doesn't talk at least to the data?
I think the risk is just the opposite, to be honest with you. I look at central banks globally. I look at the Fed specifically. To us, inflation is at the higher end and has likely peaked. You have growth globally peaking. You have earnings peaked, and then you have a situation where central banks are tightening. So to me, that's the risk in the marketplace, and I think that's the response function that we're seeing over the past few weeks.
But if you look at from a sort of normal level of rates, I mean, the old school stuff is GDP growth plus inflation. You got sort of the budget deficits running high everywhere in the world. Don't you think that there is too much risk if you see, Feds or central banks sort of being benign towards this sort of scenario, that we get into a sort of spiral situations on ever-increasing debt and ever-increasing spending, which is unsustainable. So I guess that, the Fed has got an important role to say is that let's bring interest rates back to normal level, because we are running massive deficits. And we cannot have the two things going on at the same time. It's not just sustainable.
Yeah, but higher rates don't mean higher rates. And so what I mean by that is, so just because the Fed is moving the front end of the yield curve doesn't mean that investors will move rates out higher out the curve. And so that's what you're seeing. You're seeing the response from the market telling you that central banks are tightening, which is why the curve is flattening and the fear of inversion too much. And so ultimately, the back end of the curve is driven by market expectations, as you mentioned, and expectations are telling you that the real risk is that growth and inflation just isn't as big a concern as the Fed thinks.
The market did respond at one point, though. It did start to steepen the curve. It was sort of on the page that we might actually have a strengthening inflation and that the Fed would be forced to act. That just didn't last. As soon as the market volatility hit, we started to go back to this flattening curve. What do you make of that brief window where the market did flirt with the idea and did buy the Fed line?
Yeah, it was a really interesting week and a half period, right? And that actually catalyzed kind of the broader risk-off environment for some strange reason. I'm not sure why that would be the case necessarily, other than the fact that I do think the markets are concerned about just higher rates, broadly speaking. And so it was probably an overreaction for sure, but it just talks about the sensitivity that the markets have broadly around higher rates. And let's be honest, risk markets have feasted on low rates for a very long time. And that's what QE is all about. QE is to crush cash, make it zero, and force investors out the risk curve. They have no other choice. As that starts to unwind, then naturally that response from a risk perspective also unwinds.
Very simple question. Where is the best place, if our viewers believe you're right, where is the best place for them to put their money?
Well, so I actually think we're getting to a place where duration, so actually yields are actually getting attractive, particularly in the US. And so we think we're in this environment, as I mentioned, where growth is likely peaked, inflation is not really a concern, and the need for duration, particularly in the U.S., is what is rising.
10-year and out, or?
Yeah. So 10 years is a good part of the curve, I think.
And just to cover off something for us, I mean, there's a lot of stress in the market around the size of non-financial corporate debt at the moment, particularly in the United States, and the degree of leverage and BBB and Cov-Lite and so forth. Is that the source of the next real financial cataclysm, or do you think that story is being overplayed?
That is a clear stressor in the market, and so there's a couple places that I think we're most concerned about. If you look at investment-grade corporates globally, particularly in the U.S., the BBB part of the market is a concern. you have the highest amount of leverage on balance sheets without a recession that we've ever seen. So, you know, that is a clear concern. There's also a concern in the loan market broadly, as that's really where a lot of the new issuance has happened, and then also the private debt market. So those are the three things that we're watching, and so we'll see. But it's definitely something to watch out for, and I think you do need to have additional premium to own that type of asset.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.